Environmental, social, and governance (ESG) investing is a type of investing that considers the environmental, social, and governance performance of companies before making investment decisions. ESG investors believe that companies with strong ESG performance are more likely to be successful and profitable in the long term. Don't forget to like and subscribe. ESG investing has grown rapidly in recent years. According to a report by the Global Sustainable Investment Alliance, ESG assets under management reached $35.3 trillion in 2020, representing a 15% increase from 2019. This growth is expected to continue in the coming years, with some experts predicting that ESG assets could reach $50 trillion by 2025. There are a number of factors driving the rise of ESG investing. One factor is the increasing awareness of global sustainability challenges, such as climate change, social inequality, and corporate governance issues. Investors are increasingly realizing that these challenges can have a significant impact on the financial performance of companies. Another factor driving the growth of ESG investing is the increasing availability of ESG data and investment products. In the past, it was difficult and expensive for investors to assess the ESG performance of companies. However, today there are a number of ESG data providers and investment managers that offer products and services that make it easier for investors to incorporate ESG factors into their investment decisions. The rise of ESG investing is also being driven by regulatory changes. In recent years, a number of governments have introduced regulations that promote ESG investing. For example, the European Union has introduced a number of regulations that require financial institutions to consider ESG factors in their investment decisions and to disclose ESG information to their clients. The rise of ESG investing is positive for both investors and companies. For investors, ESG investing can help to reduce risk and generate long-term returns. For companies, ESG investing can help to attract and retain customers and employees, improve access to capital, and reduce regulatory risk. How ESG investing works. ESG investors consider a wide range of factors when making investment decisions. These factors can be divided into three broad categories: environmental, social, and governance. Environmental factors include a company's performance on issues such as climate change, pollution, and resource conservation. Social factors include a company's performance on issues such as human rights, labor relations, and employee diversity. Governance factors include a company's performance on issues such as board composition, executive compensation, and risk management. ESG investors use a variety of methods to assess the ESG performance of companies. Some investors use their own proprietary ESG rating systems, while others rely on ESG ratings from third-party providers. Once ESG investors have assessed the ESG performance of companies, they can use this information to make investment decisions. For example, ESG investors may choose to invest in companies with strong ESG performance and avoid investing in companies with poor ESG performance. ESG investors may also choose to invest in companies that are taking steps to improve their ESG performance. Benefits of ESG investing: reduced risk. ESG investors may be able to reduce their investment risk by investing in companies with strong ESG performance. Studies have shown that companies with strong ESG performance tend to outperform companies with poor ESG performance in the long term. Enhanced returns. ESG investors may be able to generate enhanced returns by investing in companies that are well positioned to capitalize on future trends. For example, companies that are investing in renewable energy and energy efficiency are well positioned to benefit from the transition to a low-carbon economy. Positive impact. ESG investors can use their investments to make a positive impact on the world. By investing in companies with strong ESG performance, ESG investors can support companies that are working to address global sustainability challenges. There are also a number of challenges associated with ESG investing. These challenges include data availability. ESG data is not always available or reliable. This can make it difficult for investors to assess the ESG performance of companies. Lack of standardization. There is no universally accepted standard for ESG investing. This can make it difficult for investors to compare the ESG performance of different companies. Greenwashing. Some companies may engage in greenwashing, which is the practice of making misleading or exaggerated claims about their ESG performance. This can make it difficult for investors to identify companies with truly strong ESG performance. There are a number of trends in ESG investing that are worth noting. One trend is the increasing focus on climate change. Investors are increasingly realizing that climate change is a major financial risk. As a result, many investors are looking to invest in companies that are taking steps to reduce their carbon emissions and adapt to the impacts of climate change. Another trend in ESG investing is the increasing focus on social justice issues. Investors are increasingly concerned about issues such as human rights, labor relations, and employee diversity. As a result, many investors are looking to invest in companies that are committed to promoting social justice. Finally, there is a growing trend towards impact investing. Impact investors are looking to invest in companies that are making a positive social and environmental impact. Impact investors may invest in companies that are developing renewable energy technologies, providing affordable housing, or improving education and healthcare. The future of ESG investing is bright. ESG investing is expected to continue to grow in popularity in the coming years. This growth is being driven by a number of factors, including the increasing awareness of global sustainability challenges, the increasing availability of ESG data and investment products, regulatory changes that are promoting ESG investing. The growth of ESG investing is positive for both investors and companies. For investors, ESG investing can help to reduce risk and generate long-term returns. For companies, ESG investing can help to attract and retain customers and employees, improve access to capital, and reduce regulatory risk. How to get started with ESG investing? If you are interested in getting started with ESG investing, there are a few things you can do. Educate yourself about ESG investing. There are a number of resources available online and in libraries that can teach you about ESG investing. Choose an ESG investment strategy. There are a number of different ESG investment strategies available. For example, you may choose to invest in companies with strong ESG performance, or you may choose to invest in companies that are working to improve their ESG performance. Select ESG investment products. There are a number of different ESG investment products available, including mutual funds, ETFs, and individual stocks. Monitor your ESG investments. It is important to monitor your ESG investments over time to make sure that they are meeting your investment goals and objectives. ESG investing is a complex topic, but it is an important one. ESG investing can help investors to reduce risk, generate long-term returns, and make a positive impact on the world.